We've got quite a bit of content here. So get started here. I'd like to thank you all for joining us today for what we think will be an interesting and engaging panel discussion on subordinated debt, a pretty broad term that describes a range of financial instruments that can be used by companies to fund growth, finance acquisitions, or fix broken balance sheets. Let's start by thanking our panelists, our sponsors today. Given that this is a joint ACG and TMA event, both TMA and ACG are supported by many fine companies. Thanks, Amanda, for putting the sponsors. I guess this looks like TMA sponsors. I'd like to actually thank the gold sponsors, specifically ACG gold sponsors, Cohen and Company, Dowda Mann, Dykema, Huron Capital, Jaffe, JP Morgan Chase, TMA gold sponsors, B. Riley Advisory Services, BDO, Capstone Partners, Crestmark Bank, Dickinson Wright, DWH, First Business Bank, Great Lakes Business Credit, Kerr Russell, McDonald Hopkins, O'Keefe, and Plunkett Cooney. I'd like to introduce our panel of experts that will share some great information with us, starting with Alex. Alex Conti is a managing director and founding member of UHY Corporate Finance. UHY Corporate Finance is a national M&A advisory and financial due diligence firm serving middle market business owners. Over the course of his career, Alex has advised on sell-side transactions that combined for over $1.5 billion in deal value. He's been recognized for his accomplishments in the field by multiple trade publications, including most recently receiving the honor of 2020 Investment Banker of the Year from ACG. Alicia Masse joined B. Riley Advisory Services as a senior managing director in the Detroit office in 2020. Prior to that, she was the founder of Alderney Advisors, a business advisory firm providing financial and strategic solutions to high risk, high stakes, challenging situations, primarily in the automotive industry. Having led over 100 distress engagements, Ms. Masse has a proven track record of leadership, achieving optimal solutions in difficult and complex situations. Clayton Vanderpool. Clay Vanderpool is a senior vice president with PNC Business Credit, where he focuses on financing LBOs, dividend recapitalizations, ESOPs, high growth, turnarounds, and cyclical businesses seeking flexibility and durability in their capital structure. He has spent nearly 16 years in banking and finance, but gained considerable experience serving as the vice chairman of the board for a tribally owned economic diversification company, and is the managing director of DWH, a boutique financial advisory firm. Keith, Keith, I was going to practice this, Chulumovich, excuse me, I apologize, Keith. Keith is managing director with O'Keefe, focused most of his efforts in the turnaround advisory space, including strategic advisory services. He's also the director of business development for Grow Michigan, a mezzanine fund sponsored by the Michigan Strategic Fund and members of Michigan's banking community. Keith is an accomplished finance leader focused on strategic planning, executing against financial goals, business analysis, financial reporting, process improvement, and financial services. So today we have some structured questions, but we'd like to get some questions from the audience as well. As things come up, please feel free to shoot us some questions via the Q&A, and we'll try to work them in as appropriate. Maybe to get started, given the subordinated debt is a pretty broad term, let's start by defining what that is. Alex, what is subordinated debt? What are the different types and how is that used?
Thank you, John. Good to be with you and the rest of the panel today. I think it's the definition could probably go on a long time, but to keep it short, I'll call it sort of debt owed to an unsecured second lien creditor that sits behind senior debt in the debt structure or priority of a liquidation. So it's only paid if and when the senior debt obligations are satisfied in the event of a liquidation, and may only be serviced to the extent that the senior debt payments are being satisfied in full. So it's you use the term junior debt or subordinated, it is subordinated to a senior credit structure. In terms of the different types, there's a wide range of different types that kind of fit into that subordinated debt definition. Just a couple of those, mezzanine or unitranche junior capital. There's what's called, first in, last out, or FILO, ownership notes, seller notes. Those are all forms of subordinated debt instruments. So just to cover off on some of those, I think mezzanine is one of the more common types. People hear that a lot. So you think mezzanine, like the mezzanine level of a building, it's sitting in between basically debt and equity in the capital structure of a business, and it carries some of the features of both. Mezzanine debt will carry interest like traditional debt, but there could be a payment in kind portion where it simply accrues and it's not paid. And that's kind of similar to features on equity where, your value is accruing. It's not paid as distributions necessarily. Also, mezzanine debt may not amortize. It may be just paid in a balloon or a bullet at the end of the defined term. So unitranche or junior capital is basically like a blend of senior and subordinated debt. Instead of senior debt with an interest rate of, LIBOR plus 300, and then you've got subordinated debt or mezzanine that carries a dramatically higher level of interest, like say, 12 or 15%. Unitranche is going to be a blend of those two. So it could be one slug of debt that carries an interest rate somewhere in between, like a hybrid of, 7.5 or 8%. We talked about, I mentioned FILO, first in, last out. That's kind of a crossroads between senior and mezzanine debt. FILO is always part of a larger lending deal and can be used to extend, the advance rate on assets. For example, senior lender might advance 60% on the assets. FILO lender may go another 20%. So for a total advance rate of 80%. FILO loans are most often part of a senior revolver, but may have some mezzanine type features because they're fully funded at closing. And when they're paid in full, they're not reborrowed. So that's kind of the last out feature. The first in is the fully funded at closing, and then when they're paid out, that's kind of it. It's not a revolving facility. Owner notes or seller notes. Again, the owner of the business may decide to fund the business using debt instead of equity in the form of notes. He or she's note will be prioritized below and subordinated to any third party, senior debt. So, if a seller of a business may decide to hold a note, from the purchaser, which may, reduce the amount of proceeds that the purchaser needs to come up with to fund at closing. So those are kind of a quick summary just to maybe get us started on the different types of sub debt.
Yeah, sounds good, Alex. Thank you. How about Keith? Do you have any thoughts on that?
I do. Well, thanks for the intro, John and Alex. I appreciate a little bit of the intro. I mean, as Alex said, there's all kinds of debt, and I'm sure there's 50 more types of debt that weren't even discussed. And I think a lot of the types of debt you see anywhere has to do with the creativity, who is putting a deal together. That's the bottom line. We've all seen different things in our careers over the years. It really comes down to creativity. And this creativity really stems from an attempt to leverage the borrowing capacity of any company. I've only got so many things that I can lend on. A senior lender is only going to go so far. What can I do to enhance the amount of capital I can borrow from somebody else? In other words, I don't want to do it with my money. Who can I borrow from, and how can we do that effectively? And that's the main thing with all the pieces of debt that Alex mentioned. They're a different way to lever the borrowing capacity of whatever the company is and whatever industry they happen to be in. And the terms can range from soup to nuts, as they say. And we'll touch upon a couple of those things as we go through, but just kind of keep that in mind. It's really just enhancing the borrowing capabilities of the individual borrower.
Sounds good. How about Clay? You see sub debt, I think, a fair amount in your deals. Do you have any thoughts on?
Yeah, I think it's kind of interesting. I think I would just expound a little bit on the unitranche, and I think it plays right into what Keith was saying with the creativity aspect and where it came in. When you look at unitranche, which is, mezz has traditionally been one of the main portions of sub debt. I think unitranche continues to grow in the M&A and growth side of the market, but unitranche was kind of brought in to solve a rather specific problem of that, when you have your senior debt and your mezzanine debt, the mezzanine debt, as Keith pointed out and as Alex talked about, doesn't always amortize at a similar rate as what the senior debt rolls off at. And so your weighted average cost of capital starts getting a little out of whack, when you've got your mezz debt, which is going to be probably 10% interest plus versus your senior debt, which is 3%. And your senior debt requiring a higher amortization than your mezz debt. The idea of unitranche is to kind of blend the two, right? So you get a steadier weighted average cost of capital. So as you delever the way you're supposed to be doing, you're not changing your cost of capital to that higher tier. You're not constantly coming back to refinance and restructure your deal to keep your costs down. It's a little bit steadier over time. At the same time, it can kind of bleed out a little bit of the amortization a little bit more. So you're not constantly rolling off that senior debt at an accelerated rate. You can get kind of the average amortization. So it's a little bit easier on the cash flows of the business. But I think as Keith pointed out as well, when we're looking at any of these, and there's another potential 50 more obscure ways of structuring your debt that are out there, it's about the combination. And once you get into the combinations of pairing senior debt and sub debt and the different ways you can do it, the combinations are almost endless of the way you can do it. It's really about, you should be thinking about this in the objective of what is your goal with your debt? What are you trying to get done? And while sub debt plays both in the growth and M&A side and the distress side of the business, I think you'll find that when you get into the nuanced pieces of how that sub debt functions in each of those scenarios, it's going to be a little bit different. So, but nonetheless, I think the combinations are very intriguing for most investors on either side.
Awesome. Super. Well, I think that dovetails well into our next question. So thanks, Clay. Because really sub debt, as I understand it, sub debt, the types of sub debt vary based on, can vary based on the size of companies and industries. Not every industry, not every company size is going to be a fit for this kind of range of sub debt type instruments that we're talking about. Keith, what would you say about that in terms of company sizes or industries and sort of future capital?
Thanks, John. I think, and it's been touched on, I think first and foremost, that the structure of the debt really has to fit the company, what's going on in the life cycle of the borrower. If they're a traditional tube bender that's merely expanding facilities or buying some machinery, you structure your debt in a little more traditional manner. If it's a company that's got some IP that hasn't quite been monetized yet, but you believe that they will be able to monetize it, then you would structure your debt around how the cash flow of that particular borrower may end up flowing. It comes down to that creativity that was mentioned a couple times by both Alex and Clay, and there's lots of ways to do it. The interest only, the deferred principal, balloon payments, PIK interest. There could be a specific amortization period on the loan. It could be tied to an event, whether it's a public filing or a sale, that type of thing. There's lots of ways to put these together, and it's really limited by the creativity of whoever's putting it together. Of course, there are costs in all of these things, so you can't go hog wild, because you could chew up a lot of benefits and fees, and not that any of us professionals would mind that.
You work for free, right, Keith?
Right. Oh yeah, always.
Right.
After 12 hours, I work for free. That's right.
The first 12 hours.
That's right. That's right. The key thing to remember, I think, is mezzanine debt, as we were talking about, subordinate to senior. And because of the higher risks, it all by itself, it sounds really expensive, right? Oh, I don't want to pay 15%. I want to pay 20%. But in that same notion as kind of a unitranche format where you're taking a combination of different debt types, you end up with we'll just say a reasonable interest rate and the maximum amount of borrowing leverage that the company can get. And that's the key thing. And that's what's, when you're doing this and someone may say, oh, you're a banker, that's kind of boring. Well, this creativity, probably, I'm not going to speak on behalf of everybody, it kind of gets your juices flowing a little bit where you're kind of getting creative and you can exercise the experience you have and the structures that have worked in the past and are likely to work in the future. So.
Yeah, I agree. As a banker, former banker, lender, agree completely. Alex, what do you think? I mean, as you're working with companies of varying sizes, I would guess that sort of company size or specific industries has a major impact on the types of junior capital that's available to them. Do you have any thoughts about that?
Yeah, it does. I hard to completely generalize, but certainly there are some trends that make sense. And I think a lot of times the smaller companies are typically supported by asset-based loans or ABL, whereas some of the larger companies are trusted with more toward the cash flow type lending and general sort of performance results of the business in terms of earnings and distributable income. The industry is important too, John, as you mentioned. That the industry kind of dictates sort of the asset base of the company. I think Keith mentioned a tube bender, for example. Manufacturing company is going to typically have a substantial amount of fixed assets, between machinery and equipment, and then also inventory. And creditors like to have valuable assets, as collateral in the event of a default. So that can kind of dictate, the structure and what a lender can get comfortable with. If you compare sort of that tube bender to maybe a service company where they're relying on sort of the workforce to generate sales, profit, and cash flow, and it's sort of asset light, that's kind of the other end of the spectrum. I think all other financial metrics being equal, a lot of times a larger company and the larger asset base, the more creative and comfortable that lender can get with the debt structure. Certain types of sub debt can therefore be more accessible to certain types of borrowers. The asset intensive business that's larger could be better suited for a big slug of mezzanine debt, whereas a smaller business might need to rely on sort of an owner note.
Yeah, awesome. It makes sense. Alicia, how about you? You have thoughts on different industries. Do you have any thoughts on how sub debt can be applied based on company size or company industries? Alicia, I think you're muted. Perfect.
Thank you, John, for informing me I'm on mute. I'm always looking for the button, and it's in different places. But anyway, thanks for having me on the panel today to give a little bit of the restructuring perspective of subdebt, which is interesting because sometimes companies are in need of subdebt, but depending on where they are in the restructuring, I would say life, are they just beginning to deteriorate or have they significantly deteriorated? Usually I come in when they're significantly deteriorated and there's one either subdebt already in the structure, or they're trying to get subdebt into the structure and they can't. So it's, as most people know, I do most of my work in the automotive space, but subdebt can be used, as Alex was saying, in any industry. But it always comes down to analyzing, does the company have a reason to be? Does the company have some kind of competitive advantage, whether it's large or whether it's small? If it's large, it's pretty much already proven to be it's okay, other than you will see many times large companies file for bankruptcy. And there's usually been several missteps along the way. But in terms of size, I think it can vary. I mean, you have companies like Grow Michigan who will work with smaller mid-sized companies. You have some of the larger subdebt players who will deal with the larger companies. So I think I think there's an opportunity to have sub-debt amongst many different kinds of companies, many different sizes of companies. And I agree with Alex in the sense that it might be easier to have a sub-debt component inside of an asset-rich company as opposed to not an asset-rich company, and you're a service company primarily with people. And a lot of it too is driven by your debt to EBITDA ratio. I think, from automotive, you want to see 3 or less. For maybe some other industries, you could be closer to 5 or 7. But it all is dependent on the industry that you're in. And we'll talk a little bit more about some of the aspects that we see in restructuring when we come upon sub-debt. So back to you, John.
Super. Yeah, awesome, Alicia. So we'll kind of pivot back to more of the M&A side of the application for sub-debt. Maybe Alex, so what types of sub-debt are used in growth financing or M&A financing? As you're working with clients, client might want to sell, certain amount of that can get done on, or the buyer, so maybe you're working on, and you're helping a buyer arrange financing. A certain amount of that can be done on a senior debt basis. How does mezzanine debt or subordinated debt help get deals done? How does that help you close deals?
Yeah, on the M&A side, very useful in M&A deals because it increases the borrowing capacity of the buyer. And, generally speaking, the more you can borrow, the more you can pay. And so buyers are happy to borrow more, get the expanded, credit facility because, then they can offer more. And so that allows them to potentially win in a competitive bidding process, with adding mezz onto the senior component. Obviously the seller is happy to receive the additional proceeds. And then the benefit of mezz and the structure is that, as we talked about before, it won't necessarily amortize. You have features that can kind of turn off the cash interest. That allows the business and the new buyer, the new ownership group time to sort of build momentum. They can kind of focus on the business and growing it in the near term and then kind of worry about paying the mezz loan down the road. In the case of private equity, they're big borrowers of more complex credit structures. And so they've got a prescribed, investment horizon or, an ownership period. And so they can focus on paying the mezz loan down the road, ideally maybe when they exit the business. So it's incredibly useful, on the M&A side of the market. John, you also mentioned just general growth financing for a business owner. I think it can be very useful there. A company looking to expand, a service line or a certain growth initiative that's going to require some capital. If a company is looking to support a new manufacturing program, Alicia mentioned automotive. Sometimes there's an opportunity to go out and get new business, but you need sort of the fixed assets and some of the investment to support that program. So mezzanine can be a useful tool there if the senior credit facility sort of maxed out based on the existing asset base of the company or the earnings profile. Clay can talk about it, but I don't think some of the senior lenders really have an appetite for the, if you build it, it will come type of dynamic. And so that's where a mezz lender can come in and say, hey, I'm comfortable with the added risk here, given the enhanced return that they're going to ask for in terms of the mezz coupon. So there again, we talked about the fact that mezz may not amortize. You can kind of turn off the cash features. So in terms of supporting that new program, the business or the business owner can focus on launching and ramping up production and then eventually collect from customers before they focus on, paying down the mezz loan. So there's a number of reasons where I think mezzanine is a very effective tool, both in the M&A market and then on the growth initiative side of a business.
Super. Yeah, Clay, I mean, you must see mezz in a fair number of your financings. As you're working with PE groups on an acquisition financing, mezz is fairly common. What are your thoughts about that?
You know, it's kind of interesting, and real quick before I get into the M&A aspect of it, I think to Alex's point, it's as far as a growing company, you know, it's a little bit more patient capital, you know, that comes in, and I think that part's nice from a you know, when you have a company that needs to add that extra line or what it may be. You know, leverage tolerances, there's still going to be leverage tolerances, but they'll definitely go higher than, you know, potentially some equipment finance loans might go. There's also the PMSI debt that's an option out there too, but they're going to have a faster amortization rate, so not quite as patient as, you know, mezz can be in different situations. But from an M&A standpoint, I'd say, you know, the main benefit from it is just what Alex was describing. You know, it allows us to push the leverage up higher, and allow for a better purchase multiple going forward for either the seller to sell at or for the buyer to buy at. It's kind of interesting, you know, as we look at it kind of, again, from that distressed versus, you know, growth or M&A aspect in the lens, the scenario in which you're looking for and the structure in which you're looking for varies a little bit. And just, I'll let Alicia cover all the distress piece or maybe chime in a little bit here and there. But I think from the M&A aspect, it's not only a matter of pushing the purchase multiple higher or the cash out as much. For the buyer, it's about also kind of maximizing that IRR on the equity that they're investing, right? So the more you can push debt to a certain amount and at a certain cost, it can help you maximize the return on the smaller piece of equity that goes into the company. You're still going to run into, I mean, most lenders are going to want to see anytime you're making an acquisition, we'll just call it 30%. I mean, that number moves up and down a little bit, equity into a deal, but the more you can lever that up, the higher you can, you know, create a return for your equity investors in that standpoint. Now, obviously, you can get pretty deep into leverage at times, and at a certain point in time, the cost of that leverage is going to start to be punishing to your return. So there's a balance to be struck there. But I think that from the overall aspect, you know, in the M&A world, it helps not only increase potential purchase prices, but, you know, also the return for the investors.
Got it. That's important. Keith, how about you? Do you have any thoughts on M&A or growth financing, sub debt?
Well, I think not that I dabble in the M&A world too often, but in terms of growth, I mentioned IP earlier. I just wanted to point out that a lot of lenders don't lend on IP, especially if it's not proven yet. It's just still a great idea. And we actually took a first position. This is the way it was structured. We took a first position on the value of the IP because we strongly believed in it. And this goes back to the creativity of putting a deal together. So if somebody's trying to grow, and there's a lot of people that have the next sliced bread out there and they want to get a patent on it, it's tough to find a lender that'll lend on that. So if you can find the right type of, whether it's sub debt or some other form, and they can buy into that, then the deal can be structured where you do have, well, you get a first on this, and these other lenders have a first on more traditional assets or that type of thing. It is a good tool that can be customized to meet those growth needs.
Got it.
I think that's actually John, if you don't mind,
Yeah.
Keith brings up a great point, is that when you get into the sub debt and the BDOs and the FinCos and the rest of it as well too, you'll find that there are certain risk tolerances in industries that some like certain industries and have grown comfortable with them and are willing to get deeper than others. And there's some industries that are just hands off. And, you know, just to give an example out of, you know, my work, you know, we've dealt with a company at one point in time that had exposure into what I'd call the firearms accessories business, not lending to a manufacturer of weapons or clips or ammunition or anything like that, but something for more hunting related enthusiasts. And some lenders were totally hands off to that transaction and others were comfortable with it. So again, I think it goes to not only the creativity, but knowing the various options and who the players are and what they'll do out there. I think as Alicia will probably tell us, you know, automotive is probably viewed in a very similar space. You know, there are probably those who, you know, are just completely hands off to automotive. They don't like the industry and the cyclicality that it sees. And there are others who are all in They love it. They know what they're doing in it and are willing to be better terms. So I think as we talk about sub debt and the rest of it, it's not just a matter of can it be obtained, but and what it'll look like. It's also remembering that with different lenders, it's going to look a little bit different, and knowing which ones to approach is always going to be important on that.
Super Ed. Thanks, Clay. Oh, excellent. Let's do that. Let's move to Alicia here a little bit and talk about restructuring. We've talked about sub debt and M&A, but how's sub debt used in a restructuring financing? There's, I think, maybe not so much. Well, anyway, undercapitalized companies, the common credit officer suggestion is go get some sub debt. But you know, that doesn't always work. So in turnaround situations, if there's a need to replace depleted capital, bring some stretch suppliers current, pay down a senior lender, how can sub debt be used in restructuring capacity, or when does it work? Is maybe a better question. And Alicia, you're muted. You're still muted, Alicia.
Sure, John. So I'm going to talk about 3 different examples of what I've experienced, and I'm sure the panelists here have experienced other things as well in a sort of a distress situation. But again, it comes down to how strong are the cash flows and how strong is the asset base. And it's generally the first secured lender is probably sewed up all the assets and more money is needed. And you're right. Why don't you go out and get some sub debt? And in the first case that I'll talk about, that's exactly what the company did. They hired an investment banker. They went out and they sought sub debt. And it came back, you know, due diligence. Here's the sales of the company. Here's the EBITDA of the company. We just don't think it's a good opportunity for us. They could not find sub debt at all. So they tried and they didn't get it. The second one was a company that it fell on hard times primarily because they had lost a customer, a significant customer, but there was already sub debt in the capital structure. This was a private equity owned company, been private equity owned for about 4 years. And during the time that they tried to turn this thing around, they had your traditional senior lender and they had a sub debt lender. And I would be very interested to hear what the panelists think about sub debt in terms of being secured or unsecured. And you could say, well, they're really unsecured, even if they're second or third down into the chain, right? Because the first is already secured and sewed up most of the assets, but the others are second secured, third secured. And a lot of times I think they like to have the secured aspect of it, even though, you know, down further in the food chain, they may not get repaid through a sale process. They still like to have the aspect of being secured if by the off chance there are excess proceeds from a sale process. So in the second case, we already had sub debt in, and it did satisfy or help the turnaround until such time that they had a major customer leave, and then that's when we got involved. The third case was they didn't have any sub debt. It was a restructuring. They had run out of cash. And the question was, how was this company going to be able to survive? And so the customers looked at the company, the debt holders looked at the company, and they had actually recently brought in a new CFO and a new COO who were quite talented. And it's probably the best operational turnaround I have seen in my career. And I've seen a lot of failed turnaround operations. But this one was a fiber plant, many fiber plants. And if you've ever been in a fiber plant, there's usually fibers, you know, everywhere, in the air, on the floor, in your hair, in your clothes, everywhere. This COO, he was truly a team builder. And I think that's also very important, that the team the management team have a strong sense of bringing the team together. And he did. First thing he did is he walked out on the floor and he gave every single operator of a machine a broom. And he said, your place has to be spotless every single day. And after about a month, you could actually walk out on the floor and it was spick and span. So where does the subdebt come into play? The subdebt comes into play because the company needed a number of different things. It needed some pricing. It needed a great COO. It needed a good CFO. So we knew exactly where the problems were at the facilities, and then you could address them. The COO either addressed them or he worked with the customers to address them. But we still needed a bridge to get them from where they were operating to where they could be operating. And so we were able to get subdebt into the company. And I would say it took them about 3-4 years to completely turn around the company. Subdebt was repaid. The first lien holders were in good shape. They weren't fully advanced, and they went on to purchase additional companies. So in that sense, you know, and I see the name of this session that we had, how subordinated debt can be a valuable tool for growth and restructuring. It actually can be very valuable in a restructuring, but you have to have some very critical factors: customers who are patient, a great management team, a great CFO, and lenders who are willing to work with you. And if you have those things, then you will have no issue getting the correct funding in for the company. So those are the things I've seen in terms of subdebt in a restructuring.
Super, Alicia. That's great. I think that helps quite a bit. And you mentioned, kind of touched, you said something kind of leads to the next question, which is, sometimes these turnarounds, if a company can get sub-debt, it doesn't go perfectly smoothly. And there can be bumps along the way in that turnaround process. How is it working on a restructuring with sub-debt? So a company is able to, they're in a turnaround situation, the balance sheet is stretched, they're able to raise some capital, but there's unforeseen circumstances. How is it working? I mean, the sub-debt lender might have different interests than others in that capital structure. How is working with a sub-debt lender in a restructuring?
Well, it's been my experience that it's very similar to working with any lender in a restructuring. They all are interested in getting repaid and seeing the success of the company. They are more aligned with equity because they have a longer term time horizon. They might have to, you know, fund up a little bit in order to get the thing back on track because the senior's not going to do it. And they might also implement maybe, you know, paid in kind interest. But I would say that, like the first secured, sub-debt lenders are very, very active in a restructuring process. And I think this is going to be discussed here, so I'm not going to discuss it very much, but there are, as everybody knows, these intercreditor agreements. And those intercreditor agreements set forth the rights of each of the lenders. And in a situation that I had, we had not only first, it came with subordinated debt, but we added subordinated debt on top of that. And everybody's vying for a position with respect to being secured behind the first lender. So I would say they are very active in a restructuring situation to understand exactly what the outcome is going to be for the company, whether it's going to be a sale or whether we're going to try to turn it around. And they very much stick to the letter of the agreements with respect to what their rights are. And I find that they're just as active and involved as, say, the first secured lien holder.
Got it. Okay, super. We're doing pretty well on time. I'm going to maybe ask everybody to we'll try to be a little bit expeditious here as we're working through. We're about 45 minutes into the panel here today. The next question is maybe a type of junior capital that we haven't talked, or maybe we got hinted at, but maybe not talked about directly, and that is loan to own situations, which can be junior capital, maybe strategic investors. Maybe we could kind of briefly touch on, is this something that we see in the marketplace? And what's kind of the relative merits of that? Alicia, maybe you could start on that.
I'll start on it. It's still very much a real tool for people who are lending behind a first secured lender. You saw it a lot during I would say the turnaround days of 2008, actually leading up to 2008, 2006 to 2008. You saw a lot of the loan to own strategies occur with many of the large tier one suppliers that we have here in Detroit. It's still very, very active. The latest one that I'm familiar with is called Garrett Motion. I won't spend too much time on it other than to say Garrett Motion does turbocharging, 100% turbocharging, has fantastic EBITDA, like 18%, which is like, something you don't normally see in the automotive world. But they were a spinoff from Honeywell. Honeywell purchased them and they spun them off with $1 billion worth of asbestos liabilities, plus some other liabilities. And when the pandemic hit, they took the opportunity to file for Chapter 11. And then they had a stalking horse, KPS, which, I mean, amazingly, they started out at like 2.3 billion and they worked their way up to 2.9 billion because there was a competitor offer. And the competitor offer was Centerbridge, Oaktree, and Honeywell. So Honeywell was, in a sense, credit bidding their, it was a subordinated indemnity agreement. So there's that infamous word subordinated. So they could parlay that into a preferred equity structure in the deal. And together with that and what Centerbridge and Oaktree were bringing to the table, they actually purchased the company back. So it's still alive and well and very much an active tool.
Super. Clay, how about you? You probably see this once in a while.
Yeah, I mean, I think to Alicia's point, we haven't seen it much in the last, probably 5 years or so. I always find it interesting, the nomenclature of loan to own. It sounds a bit nefarious, in some respects, and I don't think that's necessarily the case. I mean, obviously, you're going to have it. Sometimes you see it a little bit more on the publicly traded size companies where you have hedge funds coming in and making different plays and different moves. But I think when we talk about the middle market a little bit more, and I think Alicia made the great point of, is that sometimes sub debt, especially depending on the risk scenario that they're walking into, they're a little bit closer aligned with equity, and they frankly end up functioning a lot like equity into these deals. And whether your banker, as senior banker, sub debt lender, or anybody else that's lending to you says it or not, when they're evaluating your loan, they're looking at it also from an aspect of, if I have to liquidate this, how do I get my return? How do I get repaid? And one of those scenarios is, what are my abilities to, if I think this company is being mismanaged in some way, to put the people in place or to take over the operations of this company to get it going? Especially when you get down to the sub debt lender, as Alex and Alicia have pointed out a couple of times here, that you're not really relying on the assets of the business to repay you. You're counting on this being a going concern and being repaid out of the cash flows or the sale of a company. So that's really in your interest to make sure that this company continues to function, grow, and generate enough to be sold or generate enough cash to repay you. So, the loan to own, I would say it's probably more of just one of the analyses that's being done when a sub debt lender comes in as to, how am I going to get repaid? And is it necessary at some point, if I have to take this over, can I run this to a point where I'm satisfied, where you can satisfactorily repay the debt in one form or another?
Got it. Okay. Well, Clay, let's stick with you for the next question. And that's, how do your credit people, or how do banks, do you think, or senior debt lenders view sub debt in terms of the credit evaluation? So you might be pitching a deal and it's a certain times EBITDA senior, but does sub-debt, does the magnitude of sub-debt, does the type of sub-debt, does that get factored into your credit calculation or how you folks think about things?
Yeah, I would say overall it's viewed as a positive, right? Assuming that we can get to an appropriate intercreditor or AAL agreement in those situations. But for the most part, there's a couple of reasons why it gets better. One, it puts a layer of capital kind of in between us and equity, which, based on how the agreement works in that intercreditor or AAL, it may make us more comfortable in being a little bit more aggressive in advancing against AR and inventory, or maybe a little bit lighter on the amortization than we typically would have required. But I think it also puts us in the position of where we have, another partner in the business, in a manner of speaking, another pocket that can reach in and contribute capital into keeping this company as a going concern, kind of like what we just talked about with the loan to own, maybe not necessarily in an own situation, but as Alicia pointed out in the turnaround situation, turnarounds take capital. It doesn't just happen out of thin air, and it takes investment and it takes patient capital at times. And that's where sub-debt can kind of come in and help reach that scenario of allowing the turnaround to happen. And so generally speaking, senior lenders are going to like it. It's kind of funny as I think about it in a lot of respects, we may see them, on more of Alex's and I side a sub-debt player come in on an M&A or a growth scenario. But I think, as Alicia can point out, sometimes some of these hyper growth scenarios can very quickly turn into a hyper distress situation, especially when the leverage is up there, right? And it doesn't take much for something to go sideways. And so, sometimes these scenarios, and we really haven't seen it happen too much over the last decade, I'd say, and 2020 amazingly escaping many of our expectations as to different market contractions, hasn't really put too many people in distress just yet anyways. To the point where, we haven't seen a lot of these situations happen, but it is a real possibility that when we're pushing leverage on the M&A or the growth side of the business, that's a potential where distress can come. And that's where having a sub-debt provider, another source of capital, other than just going back to the ownership and telling them to put in more equity, can bring in another partner. So it all helps us kind of get to that point and push the leverage bucket a bit.
Super. Okay, well, let's talk a little bit about what's important to sub-debt lenders. Maybe we can start with Alex. So as you might go to, on behalf of a client, go to sub-debt lenders to try to raise some mezzanine debt, what's going to be important to them, or what could you share with the audience as to, here's what you need to be thinking about in terms of what's going to be important to a junior capital type lender?
Absolutely. Yeah. First thing comes to mind is just the terms and structure of the senior secured facility. Obviously the earnings or cash flow generation potential of the business is critical. Future growth prospects, whether those are organic or through M&A. Clay mentioned, a lot of these situations are sort of a hyper growth scenario that, could very well go sideways. But in a lot of cases, the mezz lender is sort of underwriting the ownership group or the management team and how well can they execute on their plan for the business and the need for sub debt. I would also add probably just any general headwinds or tailwinds that are facing the industry or the business. We talked about, Clay mentioned before, defense or firearms related business, more on the accessory side than directly into the, munitions or otherwise. But, not everything's a fit. Not every borrower is the right fit for every lender. And so there's that cultural dynamic that also needs to fit. I think, overall, the lender needs to believe that, the senior debt can get paid, comfortably satisfied, so that the cash flow can then look at the subordinated debt. The amount and the terms of senior debt, if those are too rich, then I think, a sub debt lender is going to say, hey, I'm going to back off of this one. I don't believe that, we can get down to, my section of the debt structure. Clay mentioned this as well, but just kind of the key element is, when and how is the lender going to get their money out? When is the business able to grow, and can we execute on the plan, and will there be cash flow to eventually pay down that sub debt slug or that mezzanine slug and in 4 to 7 years, or is the lender really relying on an exit or overall sale of the business for repayment? To me, those are sort of the key considerations for a mezz lender.
Super. Keith, as our resident visiting lender here, what are your thoughts? What's Grow Michigan, or how would you comment on that, or what do you guys?
Certainly, I mean, a lot of what Alex had mentioned is true everywhere. We're as a mezz lender, we know where we are collateral wise. And in knowing that, what are we relying on? So we're relying on the management team, and Alicia mentioned that. I think everybody did. You're really placing a lot of faith in how credible that management team is. Do they know their stuff? Do they know their industry? And that leads into whatever projection you're handed. We've all seen our share of crazy looking projections. We'll use that official term. And we scrutinize those quite a bit. How believable are they, given the economy, given the industry they're in, given what's going on globally even, what's the reality of this really happening? And more importantly, at least from my point of view, I look at the level of risk and how much could they afford to miss this target by, and we would still all be okay. If we're comfortable with that margin of error, we'll call it, then we're more likely to do it. If it's so skinny that as soon as somebody coughs, it's done, we may look in another direction. A lot of things we look at, companies have losses, and if those losses can be explained and you buy into it, you're looking at things like that. What happened in the past? What makes me believe it's going to be different tomorrow? You're doing that due diligence in so many different areas. As I mentioned, the IP that we took a first position in. I mean, it's every now and then you run into that company that, I got a patent. I don't even know what it's worth. And you may find that there's real value there, which allows you to take a little higher risk than someone who's not comfortable in that space. I think the other thing is we also look to is, should we have a conversion feature? If we want to convert to equity, does that make sense to do that given what we're looking at? Is ownership amenable to potentially forfeiting a piece of their equity? I mean, we do look at all those things, and being primarily turnaround and restructuring, I have a pretty high power scope on everything I look at, because I've seen enough in my career. I know what to believe and what not to believe, what's smoke, what's not.
Healthy skepticism.
Healthy skepticism. That's right.
That's super. Super.
No,
it's a blend.
Right.
You want to be optimistic for sure.
You do. Be realistic.
Yeah, for sure. Well, hey, we're moving right along here through the hour, so I think we're doing great on time. Let me just let's talk about documentation. So, look, we've talked about what kinds of companies, what kinds of industries, sizes of companies, types of sub debt, but all that requires documentation. And senior lenders, you got junior lenders. Clay, can you maybe elaborate a little bit, or maybe educate us a little bit on to actually close and fund or document a sub debt loan? What's typically involved, or what types of documents would we expect?
The biggest one that's going to be outside of what people are maybe used to is going to be the intercreditor agreement, or the AAL if you're looking at a unitranche facility. And really what those are trying to do is kind of, I think Alicia talked about this earlier too, is just kind of govern the rules between the lenders as to who can do what when as far as their rights. Things like waterfalls on cash flows, exercising rights on covenants, mandatory standstills on defaults, waiver rights, all those things that are kind of done. In a traditional sub debt, a mezz debt, senior lender, you're going to have an intercreditor agreement, which is basically saying that there are two credit agreements. Basically, the sub debt lender has theirs, the senior has theirs. And then it's kind of a document that kind of attempts to govern both structures with the set of rules kind of set between the lenders. In an AAL, a unitranche, it's a little bit different, basically does the same thing, but a unitranche has one credit agreement to it. And the AAL is just what it is. It's an agreement amongst the lenders as to how on the side they will govern those rules, how they will, we get to the blended interest rate by, the lower risk lender skims interest rate up to the last out lender. The last out lender skims principal payment back. And then into the same things with waterfalls, covenants, treatments, exercising rights, all of that stuff. It's all kind of negotiated in there. From a borrower standpoint, you're not typically overly involved. You're definitely not involved in an AAL agreement. It's just not something that you're going to ever probably even see. In the intercreditor agreement, you're not going to be all that involved in, other than, maybe having an understanding about how these two credit agreements are being blended together to provide your facilities. And so you can understand who's going to exercise what rights when. So.
That was super interesting, Clay. In preparation for this, I was really intrigued by the idea that the client really might not see that AAL document, that's the agreement among lenders. And I thought that was interesting. Well, super. Well, we are just about out of, we're running up against the 1 hour here. Want to respect the audience's time. I really had kind of a question, really just kind of have the panelists actually do a quick, kind of as opportunities, or the audience members might be thinking, gee, I might have a sub-debt need, or I might have a sub-debt question. What types of situations are you helping with, or sort of what would be a good reason for somebody in the audience to sort of reach out to you, or ask you a question, maybe via email or something. And then I do want to give Keith an opportunity to give us kind of a thumbnail on Grow Michigan, and given that they're really rolling out with Fund 2 here, if you don't mind, maybe I'll start with Keith, and just given the fact, just kind of put him first here. Keith, can you give a little bit of a background? What happened with Fund 1? What are you guys looking to do with Fund 2? What are you guys looking for?
Sure, and I'll move quickly given the time. So Fund 1 was about a $50 million fund that sunset a year and a half ago. So we stopped lending at that point. I think we lent out about $65 million to different companies. So we revolved it. I think our average term is a 5-year amortization. I think on average everything was paid in about 3 years. And it's really to support small to middle market size companies in Michigan. Growth, retention, job growth. We had companies that were $1 million in revenues, and we had a company that just cashed out that was $120 million in revenue. So we really ran the gamut of different sizes, but they all had that same need. They had a gap with their senior lender. They approached the fund, and we were able to fill that for them, and it turned out pretty good. The second,
minimum and max deal size, and how big is Fund 2?
Sure. The second fund, I'll answer that one first. We have plans to get to 200 million. We're starting at the 50, 60 range. We'll continue to raise money. What's unique about the fund is it's much smaller in deal size than a traditional mezzanine fund. We go as low as $250,000 up to 5 million. And most mezz funds don't even get interested into the 10 or $15 million range. So we do kind of fit a unique need for that smaller client that's looking for that type of money. And it's job growth, job retention in the state of Michigan, plain and simple.
Super. Well, I think it's a great idea. It's a great fund. Clearly, Fund 1 worked out really well. O'Keefe, as a firm, has done a great job managing that. And I'm, for one, certainly glad that you guys are coming out with Fund 2. I think it's going to help companies in Michigan. Alex, as companies, as maybe lenders or attorneys out in our audience might have clients that maybe looking to buy a company, sell a company, any advice in terms of going to market for sub-debt? Any thoughts, final thoughts you might share on that? Yeah,
I mean, I think the market is incredibly active right now. you know, we're seeing the unitranche folks compete with the senior community sometimes. You know, you're seeing the headlines where there's a lot of dry powder out there. A lot of these equity funds also have, you know, specialized credit funds where they're investing alongside the equity deals, and they're finding independent debt deals or other equity partners to work with. So there's a lot of options out there. I would say, you know, just work with a trusted advisor. Make sure you're driving some competition to get the best deal.
Super. Okay. Clay, you're more kind of true middle market. I mean, kind of 10 million enterprise value on up, maybe 15 million enterprise value on up. Any advice that you might have for companies that are looking to acquire or maybe buyers and raising kind of senior sub blend? Or
No, you know, I think, you know, what we've talked about on this panel probably covers a lot of what you need to be considering. You know, to Keith's point earlier and a little bit of what I talked about, I mean, the combinations and the ways you can structure it are almost endless. You know, depending on your scenario, you can always call guys like Keith and I, but if you're really looking for a broad brush and some good advice, you know, people like Alex and Alicia, depending on, you know, if you're in that growth or if you're in that distressed phase, they can really lay out for you all of your options. You know, Keith and I are always going to slant it to what we do because it's what we do and it's what we like. But, you know, having good advisors like Alex and Alicia, I think you'll find will be able to lay out a lot of options for you.
awesome. Well, Alicia, we'll maybe close it with you then. As companies might be restructuring, or they might be, now that the PPP money is all disappearing, and their credit officer might be saying, gee, raise some sub debt. Any sort of final thoughts? You're muted. Alicia, muted.
3 times the charm, right? So I guess I would just say that you're probably not incorrect, John, in saying that the PPP funds are all used up. What I would say is that COVID-19 did not really create any real distress inside of and I'm just going to talk about Detroit in general, or automotive in general, because it's kind of everywhere, but didn't really create that much distress. If you were distressed beforehand, you're probably more distressed now. But what's really impacting, I think, companies are if you're impacted by the material shortages like microchip and stuff like that, because assembly facilities are going down. And so it's just a little bit more, it's very choppy, and it's really hard to manage choppy. So I think I have seen companies who have used up all of their PPP funds, and they are maxed out at their, you know, with their senior secured lender. So I would recommend, and generally speaking, and I think Clay, you know this, Keith, you know this, John, you know this, Alex probably knows this, is once you're in that position, your secured lender always knows, right? They are always on the front end of knowing that you have distress. So I would say to use them as a partner, really use them as a partner to get some feedback as to whom you might be able to talk to in terms of a financial advisor. Obviously, if you're a decent sized company, and that can be anywhere from 5 million going up, you probably have a trusted advisor and a lawyer. I would talk to them, and because they all have networks of people that they've worked with in the financing community. So I would use all of your networks to get to the right person.
Well, super. I want to thank everybody. I've learned a lot in this process. I've been in the banking business for a while, but certainly learned a fair amount about sub debt, and it's an educational opportunity for me. I want to thank all the panelists. I want to thank Keith Chulumovich first.
You got it.
Thanks, Alex, Conti, Clayton, Vanderpool, and Alicia, Masse. I want to thank everybody for participating. So hope you all found it as insightful as I did. So I want to thank the panelists for educational an interesting opportunity. So thanks everybody, and I think we'll sign off. I'd maybe take a couple of questions, but I think we've run along, so let's just maybe respect everybody's time and let everybody kind of get back to our regular roles here. So thanks all.
Yeah.
Thank you all. Appreciate it.
Bye.
Thanks.